Get Rich Education is brought to you by Norada Real Estate Investments and Mid-South Home Buyers.
Welcome to Get Rich Education with Keith Weinhold, giving you information and ideas on the investment that has turned more ordinary people into millionaires and billionaires than anything else, and can provide you with more wealth and happiness than you ever thought possible. Now, here's your host, investor, entrepreneur, business owner, and educator, Keith Weinhold.
Welcome to Get Rich Education, episode 61. I'm your host, Keith Weinhold. I am going to wire your mind for wealth today. I'm also going to tell you why your return from investing in stocks, as measured by that broad stock measure, the S&P 500 index, is zero. That's right. Your return from the S&P 500 has been and will be zero. Some of you are going to learn some things in a completely different way today. My slack-jawed act is back in the United States after a long foreign trip. You know, Central America is a fun, varied place in the world, but there are some days where I embrace the slower pace of life that's ingrained in Latin American culture. And then there are other days where, after dinner, I have a hard time waiting for my restaurant check to arrive. I mean, really, it's like that was a great meal that we just had, but I cannot afford to spend 4% of my entire lifespan waiting around for the dinner bill check to arrive. So please bring it now. Today, I am in beautiful and pristine Anchorage, Alaska. My wife and I spend more than 9 months per year here in this city of 300,000 people, and I consider this home. Yes, I'm back to help provide you with new ways to think about your wealth building. The S&P 500 index historically returns 10% per year, but I'm going to tell you that if you're invested in the S&P, why your return is zero. We're going to discuss more reasons as to why real estate investing beats stocks and why your returns from the stock market are significantly worse than you thought, okay? But first, back here in the U.S., there are more signs that the Fed will raise interest rates at their next meeting on the 15th and 16th of this month, which is just a few days away here. They might not, but the probability is just much higher this time around, as per remarks from Fed Chairman Janet Yellen, whom I affectionately call Grandma Weinhold because Yellen looks a lot like my Grandma Weinhold, okay? Now, contrary to popular belief, the Federal Reserve, they control short-term interest rates, okay? Not the longer-term 30-year and 15-year fixed interest rate mortgages that you're used to. So if the Fed raises rates 0.25%, that does not mean that long-term mortgage rates increase 0.25%. It does not mean that. But there is a positive correlation there, and mortgage rates typically do follow their way up shortly thereafter, okay? Now, home equity lines of credit, they do follow the federal funds rate changes in direct lockstep. As an investor, once rates rise, of course, whenever you take out new loans for future properties, you will then pay more for the interest portion of your mortgage. As real estate investors, let's think too about how your tenant perceives higher interest rates, okay? See yourself through your tenant's life for a moment here. For those renters that are on the brink of qualifying to buy their first home, they might lunge for it and make that home purchase because they fear having to buy later in a higher rate environment, just sort of like you would. Now, for that other set of renters that are not so close to qualifying for their first home, high rates are just going to put that home purchase further out of reach for them, and that keeps those renters as renters. Hopefully, you've already got your historically low interest rate locked in on that rental property that they occupy, okay? So, all right, well, from 1928 to today, the average annual return of the S&P 500 index is 10%, and your return is nothing. All right, well, how exactly is 10% nothing? There are really three main answers to that question: inflation, emotion, and fees that will make your return from the S&P nothing over the long term, okay? Now, I know that over the last few years, there's been quite a run-up in the U.S. stock market, the Nikkei, the DAX, and some other world stock markets, okay? But we're focusing on the U.S. here, and we're focusing on the very long term, which is the time horizon to profile here, because hopefully you plan on investing and living for the long term, okay? So we're not just talking about 5-year slices here. Studies have shown, and I linked to one such report in today's show notes, that due to emotion, stock and mutual fund investors lag the S&P by 4%, such that a 10% return in the S&P is really just a 6% return to you. So let's investigate this. All right, why is that? The primary culprit behind the nearly 4% lag in performance for equity investors is that investors tend to make poor choices driven by emotions. Investors react too rapidly to both positive and negative news. This overreaction, it leads to you buying high and selling low, which is exactly the opposite of what you're supposed to do, and ultimately underperforming over the long term. People fall into the trap of chasing performance or looking for the latest and greatest idea. Focusing on the long-term approach to investing is going to help prevent you from making rash decisions. It's just really hard to do, even when you think you've got emotions under control. Okay, people have a hard time being focused on the long term when you can just easily buy and sell on these lightning fast exchanges, whether that's your E-Trade account or your Scottrade account, or even the elections within your employer-sponsored retirement plan, okay? Now, look, this is what happens, all right? When the stock market has run up and up and up, and you see how everyone around you is making gains, and you're experiencing FOMO, fear of missing out, FOMO, that's exactly when you're most likely to buy more, and it feels like a no-brainer at that time because you and everyone else around you have been making money for so long, and right now could be one of those times, okay? These are also historically the worst times to buy because you just bought stock high. Now let's look at the other side. The opposite is true when the stock market goes lower and lower and lower, and you get so discouraged because you're so tired of losing money, and you've read nothing but negative stock market news stories for so long, and it seems like there's no end in sight. And you're so fed up with this that you finally sell the stock that you have because you just want certainty that the bleeding has stopped, okay? You've been beaten up for so long that you're finally willing to just give in for the economic value of certainty. Well, what happens when you do that is you just sold low because you just gave into emotions. And you know what? Your stock and mutual fund manager is subject to the same emotions. Professional stock fund managers have a hard time beating the S&P 500 themselves, okay? Now, I know what you're thinking right now, okay? You're telling yourself, no, I'm smarter than that. I know to sell high and buy low. But data shows that emotions make it such that if you earn that same return as the broader market, you're doing far better than most people, okay? Now, if you really do believe this, and you believe and you practice taking well-appreciated positions off the table, which is selling high, and you believe in plowing those dollars into beaten down equities and assets, which is buying low, then right now you're selling some of your high-flying Netflix stock and you're buying oil companies, or you're buying 100-ounce Engelhard silver bars right now, okay? You might have done that, but the chances are that you haven't. So, you think you've got this emotion under control, but you don't. It's kind of like those polls that ask people how good of a car driver they think they are, okay? I don't know exactly what the number is, but it's something like 8 out of 10 car drivers are confident that they're better than the average driver, okay? But the truth is that no more than 5 out of 10 drivers can be better than the average driver, okay? So no, most investors really do have a human emotion working against them. That's why a 10% return is really only a 6% return. And a 6% return, that 6% is driven down to a 0 to 1% real rate of return after adjusting for the long-term inflationary rate of 5 to 6% a year. Not the government-reported consumer price index, which is not the real rate of inflation, and I've talked about that in other shows, okay? But the true, more widely accepted, diminished purchasing power of the dollar, known as inflation, that arguably erodes your individual dollar's prosperity at a rate closer to 5 to 6% per annum. All right, so now you're down to a real return from stocks of between 0 and 1%, and that negligible return is consumed by fees, okay? There are typically fees in addition to the expense ratio stated in mutual funds, for example, and you're down to a real, not nominal, but real inflation-adjusted, fee-adjusted, emotionally affected rate of return of 0 or even less, but we'll just call it 0. So the problem is not the problem. The problem is about how you think about the problem. You think that a 10% return is not a problem. It is. Yes, you may be able to beat the market, but with the investment fees, inflation, and human emotion working against you, you're more likely to do so through luck. If you can merely earn the same returns as the market, you're doing far better than most people. Okay, yes, what I just described is simplified. Yes, we're here at a period in time where inflation is low. We're talking about you and the long term here. Yes, it is easy to get excited, which is another emotion, during shorter term periods of time, like, back in 2013 when the S&P gained an unsustainable 30% in 1 year, okay? That is still part of the average of 10% over the long term, all right? You need a vehicle that beats inflation, emotion, and fees over the long term, and you have that with real estate. The S&P 500 is near an all-time nominal high right now. Many individual companies in the S&P have frothy high valuations based on the PE ratio, okay? A PE ratio, price to earnings ratio, that's high. That means you're paying a high share price relative to the amount of corporate earnings that company produces. So taking a longer view here, we've been in a long stock bull market. That is a price run-up, and the bull market technically ends when there's a 20% or greater drop from the high point of the market, okay? We've currently been in a stock bull market since 2009. In fact, it's getting so old and tired that if this runs just a few more months, it will be the second longest bull market of all time, eclipsing the long bull of the early 1950s, okay? So we're making very long-term, all-time comparisons here, okay? And then the only bull market that would have been longer than this one is the tech bubble that burst fantastically in 2000, which really ushered in the use of the term bubble into the popular American lexicon. So many feel that there is more to lose than gain by being invested in the stock market now. Now, there is what I'm going to call a knowledge and rationale advantage with real assets like real estate over derivative equities like stocks, ETFs, and mutual funds too, okay? You know what some of the catalysts are that move the stock market these days? It's stuff that lacks rationale. For example, what about the ways that the world thought that China had been growing fantastically all these years with 7% year-over-year GDP growth? That mere perception of growth, that fueled world markets because the world thought that they were going to have to produce more stuff to sell to China. Well, then the world learned that Chinese electricity use, railroad use, and all sorts of proxies for industry did not add up to 7% growth. And that's when the world learned that Chinese provincial governors are incentivized for making inflated GDP reports to the Chinese central government. And the GDP grows at 7%, and that's just shown to be a charade and an outright lie, okay? Well, that stuff increasingly moves the U.S. market, and you don't know what's going on over there or how to control it. You're basing your lifestyle and your retirement future on what Chinese provincial governors report to their central government. I mean, that lacks rationale. You know what else moves stock markets that lacks rationale? It's good U.S. economic data due to a strong monthly jobs report, okay? Say that economists predicted that there were going to be 200,000 jobs added this month. And then that number came in instead at 250,000 jobs added. Okay, that exceeded expectations. That should be good news for the economy, right? And sometimes that makes the stock market go up because, well, jobs and productivity were added. Those are signs of a strong economy. But then sometimes it makes the stock market go down because, oh, well, we're afraid that the Fed is going to notice that and they're going to fear that there's going to be an overheating economy and the Fed's going to hike rates, which will cool the economy. So the stock market goes down. So it's this counterintuition and really frustration that with stocks, sometimes good news is good news and sometimes good news is bad news. It's out of your control. It lacks rationale. See, with real estate and real estate market data, if there is job growth in the metro where you own rental property, well, that's almost always going to trickle through to you positively in several ways. I mean, that means you're going to have greater capital appreciation of your property more likely than not, that you're going to have higher occupancy, and that you're going to have rent increases, which equal your cash flow increase. Okay, so that's the kind of thing that makes real estate more difficult, not impossible for sure, but more difficult to manipulate. Okay, good news is actually good news. There's more clarity, there's more rationale, and you can use your knowledge to your benefit. While you should expect your long-term return from the stock market to be zero, you should expect it to be 25% or more in real estate. I'll come back with that. I mean, the fact that people are invested in stocks largely on their own because they no longer have an employer pension, that's why they're having to both reduce their lifestyle during their working years and postpone retirement. Learn to invest in real assets. I mean, geez, stock investments by and large don't provide an everyday investor with any real gain. That's one reason that retirees are increasingly wearing a blue vest that says, "How may I help you?" in big letters on the back because they're a greeter at Walmart. I mean, my gosh, you've got to be kidding me. Cash flow real estate investors nationwide and worldwide, this is Get Rich Education's Keith Weinhold. Forbes has rated Memphis, Tennessee as the #1 cash flowing market in the world. Our good friends at Mid-South Homebuyers have been Memphis's premier turnkey real estate provider for 14 years with a stellar reputation and an A+ rating with the Better Business Bureau. Owner Terry Kerr was born and raised in Memphis. Yeah, he knows the market and has renovated and sold over 1,000 houses in the Memphis area. Find out what their many repeat buyers already know. Their houses are completely renovated, even come with a 1-year builder's warranty and a lifelong rental guarantee. They're a perfect fit for the first-time out-of-state investor or the seasoned investor diversifying their portfolio. Mid-South Homebuyers' friendly staff makes investing easy. Learn more at midsouthhomebuyers.com or give them a call at 901-217-HOME.
Are you having a hard time finding great investment properties? Unfortunately, the best deals are rarely found locally. Successful investing begins with the right properties in the right markets. Norada Real Estate provides everything you need to invest in the best deals across the U.S. Our simple, proven system will help you create real wealth and passive monthly cash flow. Get your free copy of the ultimate guide to passive real estate investing at noradarealestate.com/guide. That's NORADA realestate.com/guide.
Hi, this is Tom Hopkins, and I can't tell you how smart you are to be with Get Rich Education and make these ideas you.
Welcome back to GRE. Now, while U.S. stock markets are near nominal all-time highs right now, real estate still hasn't even gotten back to its 2006 peak, okay? And that's nationally. You know, real estate's a local phenomenon. The concept of national is always kind of funny with real estate, okay? The U.S. government measures exactly 381 national metro areas currently, okay? Now, with stocks, you can just point and click to buy and sell, but you cannot do that with real estate. With real estate, there's no panic selling, really, and you are not as likely to be subjected to the human emotion, which results in transacting at exactly the wrong time. Now, how do I say that 25 to 30% annual rates of return are common with just a modest amount of education in income real estate where a loan is used? Okay, well, numbers don't work so well in audio format, so I'm just going to provide a leaned down version, okay? What you do is you add up your sources of income property wealth accumulation to come up with 25 to 30%. Okay, so of the five ways that investors financially benefit with real estate, we'll just add up the big three ways, okay? The last two get two numbers heavy, okay? Now, if you can bear with the example on the first of these three, then you're going to have it because the next two are easier, okay? So the number one profit center for real estate investors is appreciation, okay? It's not something we can count on, but historically, real estate appreciates over time at about 6% per year. Now, note that that's really not much different than the real rate of inflation, okay? But leverage makes the difference. So here we go. With your $20,000 down payment on a $100,000 rental property, that property is worth $106,000 after the first year, okay? That $6,000 gain is a 30% return on your $20,000 down payment. Okay, if you need to rewind that part and think it through, please do so, okay? Now, how did you achieve a 30% gain right off the bat? That's because you achieved that return on both the $20,000 down payment and the $80,000 borrowed from the bank. To that 30%, add in the income we get from number two. Number two is our return from the tenant rent income, creating cash flow, which is leftover money every month after all the property expenses are paid. That often results in a 10% return, okay? Investors call that portion the cash on cash return. In this example, that's if you created $2,000 of cash flow in year one on your $20,000 down payment, that 10% gain is called that cash on cash return. So following along here, we're now up to a 40% rate of return, 30% for the leveraged appreciation, plus 10% from the cash on cash return, which is cash flow from the tenant. We'll add to that 40% now, we'll add number three. Number three is loan principal paydown. At today's low interest rates, the amount of principal paydown that the tenant makes for you in that first year is often 4 to 5% of the amount of your down payment. We'll just call that 4%, and we're going to add that to the 40%, and we have a 44% total rate of return now, okay? And again, those are three of your five profit centers with leveraged cash flowing real estate that creates that 44% rate of return. Okay, the fourth profit center is tax advantages, which are personalized to your scenario. And the fifth profit center is inflation hedging, which is to your benefit. But that's something harder to measure. I'm in a whiteboard video where I describe inflation hedging, and that is pinned to the top of our GRE Facebook page right now. Just go to Facebook, search Get Rich Education. I think I'm going to start calling it, however, I'm going to start calling it inflation profiting rather than inflation hedging, okay? Because that's really what it is. So a 44% rate of return, I mean, this is why they say that real estate investors get wealthy in their sleep, okay? Now, with the 44% total rate of return above, to keep things simple, okay, we haven't added in any closing costs when you purchase the property, but I usually get the seller to pay those for me anyway. We also didn't even include those two significant investor tax benefits, which are more difficult to quantify, like tax depreciation and the mortgage interest deduction, which basically means that we get to keep more of that 44% return. We haven't included the inflation profiting benefits either. We'll just leave that 44% alone. We won't adjust it for inflation up or down, even though there is that inflation profiting benefit when you have secured an income property loan. So a 44% rate of return. So now, if you were raised to believe that a 44% rate of return would entail some inordinate amount of risk, because with a stock market mindset, that probably would entail an inordinate amount of risk to try to get a return that way, okay? But wait a moment, we're not quite done, all right? Now, every few years, one should look at harvesting and redeploying accumulated equity. Otherwise, the amount that you invested in the property grows from equity buildup, and your total rate of return is diluted because now you have more money invested in the property in an appreciating environment. This cuts your leverage ratio, okay? As equity builds, your return on equity often erodes, okay? That's because additional equity does not contribute to your asset's appreciation at all. Some people like to say that the return on equity is kind of a farcical metric, and that's because the presence or the absence of equity has nothing to do with its appreciation rate. I mean, I like to say that there is a return on equity calculation, your ROE, but what I like to say is that your return from equity, your RFE, will always be zero. So, due to this effect of heavier equity positioning weighing down your ROE before you can refinance the property, that's why I expect a long-term rate of return on real estate to be just 25 to 30% rather than 44%, okay? You know how I've said before that anything less than a 25% rate of return from real estate is a disappointment? Management fees and other expenses are already included in that 25 to 30% inflation-adjusted rate of return. So now, let's say that a real estate investor is, a little bit affected by emotion, all right? Not as much as the 4% that the stock investor lags the S&P 500 by, though, because you can't easily buy and sell real estate. There's no panic selling. But we'll still say that the human emotional predisposition to buy high and sell low, which is the opposite of what we're supposed to do, that it still affects that real estate investor, we'll say half as much as a stock investor that is more vulnerable to that emotional condition, okay? So within that 25 to 30% range, we'll just play it more conservatively and use a real estate return of at least 25% annually for the real estate investor. Of course, there's no absolute guarantee of any of this happening, just like there's no guarantee about virtually anything in life. And we're talking about the very long-term time horizon here, okay? And again, hopefully you plan on living for the very long term, okay? I do too. So that's why this is a smart horizon to look at. So there we go. We've got a 25% annual rate of return calculated on leveraged cash flowing real estate where we're market agnostic, buying in the best U.S. markets, usually not our own home market, okay? And I've discussed how for adequate diversification, you want to select probably 3 or 4 geographic markets. We've got a 25% return for real estate versus 0% for stocks, inflation adjusted, emotion adjusted, and fee adjusted on both sides, okay? Yes, that's an oversimplification, admittedly, and there are a number of other caveats and it depends factors for sure. We haven't considered any fees to refinance the real estate. We haven't considered the deleterious math impacts of greater volatility, which lower your stock returns some more either, okay? We haven't discussed that one can get leverage with stock investing by doing what's called borrowing on margin, but that's not nearly as available to you as loans are for real estate. Borrowing on margin for stocks is also done at a lower leverage ratio, and then a margin call could wipe you out, where with income real estate, if you're underwater on a property, you might not even want to sell that property because it can be cash flowing better than ever. So we didn't get into taxes too much, and I think it's actually fairly clear that there are more advantages with real estate than there are even in your employer-sponsored retirement plan or your IRA. Okay, so overall, that's a reasonable, rational way of looking at the impact that you're actually going to feel from your investment and what's going to move you ahead in your investment life or what's going to keep you stuck in the mud, okay? 25% for real estate versus 0% for stocks, inflation adjusted, emotion adjusted, and fee adjusted. Okay, so I hope you got some ideas and perspectives such that you gain some insight from that comparison. I really did consider a lot of variables there. you often have to invest out of market with real estate. That's why we talk so much about the most investor advantaged U.S. markets and the importance of building a team, especially that property manager. Think about what most stock investors do. They buy individual stocks in mutual funds, and typically that company is often located in a different state or a different country. Oftentimes they don't even know where that company's located. Well, with out-of-market real estate, you know those things, okay? And with stocks, you also have less control with this quote-unquote out-of-market stock, okay? If you own Apple stock, how much leverage do you have in their corporate shareholder meetings in Cupertino, California, okay? I mean, do you really know the numbers behind Apple's quarterly earnings report? I mean, do you even know how to read one? Well, people consider that normal to invest in quote-unquote out-of-market stocks all day. Well, with out-of-market income property, not only do you know exactly where the property is, I mean, you could even live in it if you wanted to. It's something real, tangible, easy to understand. You've got a lot more control with that than you do with stocks. You could fire and replace the property manager if you really had to. You could have a carport added for more rent income if you so desired. I mean, you can probably read and understand the monthly property manager's statement of that property's income and expenses that month much better than you can the quarterly earnings report from your stock company. So, comparatively, it makes all the sense in the world. Yet some people invest in stocks across the country and across the world, but they won't even invest in real estate in another part of the same country that they live in. And, that's getting to be an antiquated notion that really limits you. If you limit your investment real estate search to the properties that you can drive to, you've limited your search to just 0.0005% of all the potential real estate investments in the world, okay? That's about one drip in a hot tub, all right? And sadly, a lot of people just sort of artificially and radically restrict their real estate investment search due to old-fashioned thinking. I mean, people telecommute to their jobs through cell phones and the internet. They telecommute to their social engagements through LinkedIn and Facebook, but yet they're willing to telecommute with their investments. So, it kind of comes back to the quote, live where you want to live and invest where the numbers make sense. And many have adopted this investment philosophy and they're doing really well because they can get in and out of markets and properties as the numbers and the local economies change. That's why your investments need to be geographically agnostic. That means a willingness to invest in any location where the numbers make sense. A return of 25% from real estate versus 0% from stocks. Look, the world already has your money. That's right. The world already has your money. You just need to write out a withdrawal slip. That withdrawal slip that you write out is a purchase contract for a cash flowing rental property with a loan on it in an investor advantage market with a good team. We talk about how to make that happen a lot here at Get Rich Education, and it's what's been the catalyst for change in my life personally. You hear about those actionable opportunities here on the show, and if you want more specific opportunities like this, subscribe to our free newsletter at Get Rich Education. If you're new to GRE, we're kind of different here. I'm here to help you build your wealth. I want to make you more successful than me, faster than me. Feel free to check out our resources and for sure subscribe to our newsletter, all at GetRichEducation.com. If you want to have something different in life from most people, then you need to think and act differently in life from most people. Now go out there and don't quit your daydream.
You've been listening to Get Rich Education, telling you what the wealthy won't tell you about real estate and investing. If you enjoyed the show, please take a minute to visit iTunes and leave your comments.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.